Disclaimer.
Picture this. It's 3 a.m. on November 28th, 2025, and the world's largest silver exchange suddenly goes dark. 10 hours of complete silence. No trading, no price discovery, no access to your positions. The official explanation from COMEX, a cooling system failure. But here's what should grab our attention. When trading finally resumed after this mysterious blackout, silver didn't crash like you'd expect from a technical glitch. Instead, it exploded 5% higher in a matter of hours, as if someone had been holding back a tidal wave and the dam finally broke. What if I told you this wasn't a cooling system failure at all, but rather the most desperate move in a decades-long manipulation scheme that's now unraveling in real time? Think about the timing here. Silver had been rallying hard, pushing toward levels that made some very powerful institutions extremely nervous. Then suddenly, at the most crucial moment, the exchange just happens to experience a catastrophic system failure that halts all trading right when momentum was building. According to data from the CME group itself, this was the first unplanned shutdown of this magnitude in over a decade. The odds of a genuine cooling system failure occurring precisely during a breakout rally are astronomical. But here's where it gets interesting. When that market reopened and silver surged instead of collapsing, it revealed something profound about the forces at work in our precious metals markets. The physical demand was so overwhelming, the buying pressure so intense, that even a 10-hour trading halt couldn't suppress it. This wasn't supposed to happen according to the old playbook. In previous decades, mysterious trading halts would give big players time to coordinate their positions and crush rallies before retail investors could react. This time, the strategy backfired spectacularly. Now fast forward to December 21st, 2025, a date that will be remembered as a turning point in financial history. Silver didn't just break through resistance levels, it shattered a ceiling that had stood for 45 years. Think about that for a moment. For nearly half a century, silver had been unable to decisively break above the $50 per ounce level established during the Hunt Brothers crisis of 1980. That's longer than most people's entire working careers. Generation after generation of traders and investors watched silver approach that psychological barrier, only to see it rejected time and time again. Then something extraordinary happened. On that December day, silver didn't just break $50, it obliterated it, surging all the way to $69.46 per ounce. This wasn't a gradual climb or a modest breakthrough. This was the highest price in the entire recorded history of silver trading, according to data compiled by the World Gold Council and major commodity exchanges worldwide. We're talking about a metal that's been traded and valued for thousands of years, and we just witnessed its highest valuation ever recorded in modern markets. But here's what makes this even more revealing. While the official COMEX spot price was hitting these record levels, something strange was happening in the physical market, where actual silver changes hands. Dealers across the country were charging premiums of 40% to 50% above the official paper price. Let me put that in perspective for you. If the exchange said silver was worth $60, you'd be paying $84 to $90 for an actual physical ounce from your local dealer. This massive disconnect between paper prices and physical reality tells us something critical. The paper market has completely lost control of the underlying asset. Think about what this means for your portfolio. You might look at silver charts and see one price, but if you actually wanted to buy physical metal and hold it in your hands, you'd be paying nearly double what the official market suggests. This isn't a small discrepancy or a temporary supply chain issue. This is a fundamental breakdown in how price discovery functions in our markets, and it's been accelerating throughout 2025. Now let's talk about what was happening behind those closed doors at the Chicago Mercantile Exchange while all this chaos unfolded in public view. The CME group did not just watch this historic rally happen. They actively intervened in ways that most retail investors never noticed. According to official CME notices archived on their website, margin requirements for silver futures contracts were raised 5 times since October 2025. 5 times in just 2 months. Each increase forced traders to put up more capital to maintain their positions, effectively making it more expensive and more difficult to buy silver contracts. Pop quiz. Why would an exchange repeatedly raise margin requirements during a rally? The official explanation is always about managing risk and ensuring market stability, but here's the reality. Raising margins is one of the most effective tools for suppressing price momentum without overtly manipulating markets. When you force traders to tie up more capital, smaller players get squeezed out, buying pressure decreases and rallies lose steam. It's a subtle form of intervention that flies under the radar of most mainstream financial coverage. But the real story gets even darker when you look at what's happening in the over-the-counter shadow market. This is where the truly massive positions exist, far away from the transparency and reporting requirements of public exchanges. According to Bank for International Settlements, data on derivatives, exposure, institutional short positions in precious metals, the bets against rising prices, exist at levels that are conservatively estimated to be 5 to 10 times larger than what shows up on official exchange reports. We're talking about phantom positions worth hundreds of billions of dollars that most investors don't even know exist. Have you noticed how major financial institutions always seem to know exactly when to change the rules? It's not coincidence or lucky timing. These margin increases, these trading halts, these technical difficulties, they follow a pattern that becomes obvious once you know what to look for. In November, right before that mysterious 10-hour blackout, open interest in silver futures had reached levels not seen since the last major rally attempt in 2020. Translation: too many people were betting on higher prices, and the institutions on the wrong side of those bets needed breathing room. Here's what you need to understand about how modern markets actually work versus how they're supposed to work. In theory, exchanges exist to facilitate fair price discovery where buyers and sellers meet transparently. In practice, when prices move in directions that threaten major institutional players, the rules can be changed mid-game. It's like playing poker where the house can suddenly declare that flushes no longer beat straights, right after you've gone all in with a flush. The November shutdown wasn't an isolated incident. It was a signal, a desperate move by entities that realized traditional suppression techniques weren't working anymore. When you can't hold back the tide with margin increases and coordinated selling, you literally shut down the market and hope the momentum dissipates. But that strategy revealed more than it concealed. It showed everyone paying attention that the emperor truly has no clothes, that the paper price has diverged so far from physical reality that even extreme interventions can't bridge the gap anymore. Consider this scenario. You're planning your retirement, you've been told to diversify into precious metals, and you watch silver break through decades-old resistance. Exciting, right? But then the market mysteriously shuts down at a critical moment. And when it reopens, premiums on physical metal have exploded to levels that make the paper price almost irrelevant. What does that tell you about the reliability of the markets you've been told to trust with your financial future? What does it suggest about the true nature of price discovery in our modern financial system? The December breakout to $69.46 wasn't just a new high. It was a declaration that something fundamental has shifted in global silver markets. For the first time in 45 years, the forces suppressing silver's price have lost their grip, at least temporarily. But temporary might be all they need to implement their next move, their final card to play when the system they've built starts to collapse under its own contradictions. We're witnessing the early stages of a market structure failure, where the paper contractism and derivatives that have defined precious metals pricing for decades are being exposed as the illusions they always were. The 40-50% premiums on physical silver aren't going away. They're expanding. The mysterious trading halts aren't stopping. They're becoming more frequent. And the institutional short positions aren't being closed. They're being hidden deeper in the shadows of our financial system, waiting for the moment when they can't be hidden anymore. Let's talk about numbers that don't lie, even when the institutions behind them desperately want them to. For 5 consecutive years from 2021 through 2025, the global silver market has been running a deficit. Not a small shortfall that corrects itself, but a structural deficit that's grown larger each year. According to the Silver Institute's World Silver Survey, 2025's projected deficit stands at 117 million ounces. That's 117 million more ounces being consumed than pulled from the ground. Think about that in terms of your personal finances. Imagine spending more than you earned for 5 straight years. Eventually, the credit cards max out and the bills come due. Meanwhile, global mine production has flatlined at around 813 million ounces per year, according to U.S. Geological Survey data. Despite higher prices that should theoretically incentivize more production, despite advances in mining technology, despite massive exploration efforts, the world's silver mines simply can't produce more metal. We've already found and developed most of the easy deposits. The remaining silver is deeper underground, in more remote locations, mixed with other metals in ways that make extraction exponentially more expensive and time-consuming. This isn't a temporary situation. This is geological reality. Now here's where the math becomes impossible to ignore for our economy. Industrial demand for silver has gone absolutely parabolic across multiple sectors simultaneously. Solar panel manufacturers alone consumed record amounts of silver in 2025, with the Solar Energy Industries Association reporting capacity expansions requiring millions of additional ounces annually. Every solar panel needs silver paste for its conductive properties, and there's no substitute that works as well at commercial scale. Electric vehicles use significantly more silver than traditional cars. The average EV contains roughly 25 to 50 grams of silver in various components, compared to about 15 to 28 grams in conventional vehicles. As our nation transitions toward renewable energy and electric transportation, this demand isn't discretionary. It's mandatory for technological progress. Then you have data centers, the invisible backbone of our entire digital economy. Every server, every circuit board, every connection point uses silver because of its superior conductivity and reliability. According to telecommunications infrastructure reports, 5G network buildouts alone require significantly more silver per cell tower than previous generation networks. You can't build the digital future without physical silver, and that's a fact that no amount of paper contract manipulation can change. Now look at what's happening in the world's largest silver-consuming nations, because this is where the supply crisis becomes undeniable. China's silver stockpiles have hit 10-year lows according to Shanghai Futures Exchange warehouse data. Think about the implications here. China, the world's manufacturing powerhouse, the nation that plans decades ahead and stockpiles strategic resources with almost paranoid foresight, has let its silver reserves drop to levels not seen since the early 2010s. This isn't carelessness. This is desperation. When your factories need silver to maintain production and global supplies are this tight, you draw down reserves even when every economic instinct tells you to accumulate more. India's situation might be even more revealing. In October 2025 alone, India imported 51.4 million ounces of silver, according to customs data reported by Reuters, the sixth largest monthly import in the entire 21st century. We're not just talking about jewelry demand or investment buying here. We're talking about industrial consumption, electronics manufacturing, and the massive Indian solar power initiative that requires staggering amounts of silver to meet its renewable energy targets. When a nation with India's population and manufacturing capacity suddenly needs to import silver at these unprecedented rates, it tells you something fundamental about global supply-demand dynamics shifting beneath our feet. Have you ever wondered why these supply deficits haven't caused prices to skyrocket long before now? After all, basic economics teaches us that when demand exceeds supply for years on end, prices should rise dramatically. But silver remained suppressed below $30 per ounce for most of this deficit period. How is that possible? The answer lies in understanding the 1980 playbook that's been haunting silver markets for 45 years. In 1980, two brothers from Texas named Nelson Bunker Hunt and William Herbert Hunt attempted to corner the silver market. They accumulated massive physical positions, driving prices from around 6 per ounce to an all-time high of 50. The industrial users panicked. The exchanges panicked. And most importantly, the banks holding short positions panicked because they faced catastrophic losses that threatened their very existence. So the institutions changed the rules mid-game in broad daylight. On January 21st, 1980, a day that became known as Silver Thursday, the COMEX exchange implemented a new rule that would have been unthinkable in any fair market. Liquidation only. No new buying positions allowed, only selling. Imagine playing a game where suddenly only one team is allowed to score. Silver crashed from $50 to $10 in a matter of months. The Hunt brothers were financially destroyed, forced into bankruptcy, and the message was sent loud and clear to anyone paying attention. Do not challenge the system's control over precious metals pricing, or we'll simply change the rules and destroy you. But here's why 2025 is fundamentally different from 1980, and why the old playbook might not work this time. In 1980, industrial demand for silver was relatively modest, maybe 40% to 50% of total demand, according to Historical Silver Institute data. Today, industrial demand represents approximately 120% of annual mine production. Let me repeat that because it is crucial. Industrial users alone need more silver than all the world's mines produce in a year. The difference gets made up through recycling and depleting above-ground stockpiles, but those stockpiles aren't infinite, and recycling can't keep pace with exponential demand growth. Think about what this means in practical terms for our economy. In 1980, when they crashed the paper price, industrial users could step back and wait for better prices. They had alternatives or could reduce consumption temporarily. Today, if a solar panel factory or EV manufacturer can't get silver, production stops, not slows down, stops completely. According to manufacturing industry reports, there are no viable substitutes at scale for silver's conductivity in many critical applications. You can't will a replacement material into existence when the assembly line runs out of silver paste. This is where JP Morgan enters our story, and the stakes become truly staggering for our entire financial system. According to analysis of commodity futures, trading commission data, and banking industry sources, JP Morgan holds a massive concentrated short position in silver, meaning they have bet billions of dollars that prices will fall. When silver was trading at $20 or $30, those shorts were profitable, or at least manageable. But now, with silver above $65 and the December spike to $69.46, these positions represent potential losses that dwarf anything we saw during the 2008 financial crisis. Here's the calculation that keeps banking regulators awake at night. If silver sustains prices above $70 to $75 per ounce, JP Morgan's losses on these positions could exceed their Tier 1 capital requirements. Let me translate that from banking jargon. Tier 1 capital is the core equity and disclosed reserves that regulators use to measure a bank's financial strength and ability to withstand losses. It's supposed to be the buffer that prevents bank failures. If losses exceed that buffer, you're looking at potential insolvency for a systemically important bank. That's not just a banking problem, that is a too big to fail crisis threatening our entire financial system. Now you might ask, why doesn't JP Morgan just close these positions and take their losses before it gets worse? That's the rational question, and the answer reveals everything about how our financial system actually operates. These short positions are so massive that unwinding them would itself drive prices dramatically higher, creating a death spiral. It's like trying to exit a crowded theater through a single door while shouting fire. The act of trying to escape makes the situation exponentially worse. So instead, the Federal Reserve and banking regulators have essentially given implicit permission for market manipulation, because the alternative, letting a systemically important bank fail, is deemed unacceptable to our economic stability. According to former CFTC officials who've gone on record about precious metals manipulation, this isn't conspiracy theory. It's openly acknowledged policy, justified under the banner of financial stability. The Fed allows certain market interventions because too big to fail literally means that rigging the market is considered preferable to systemic collapse. Your retirement accounts, your savings, your economic future, they're all subordinate to keeping institutions like JP Morgan solvent, regardless of what that means for fair price discovery or market integrity. The industrial users have already figured this out, which is why we're seeing a dramatic shift in how silver actually changes hands in the real economy. Major manufacturers are increasingly bypassing COMEX entirely and signing direct supply contracts with mining companies, according to metals trading industry sources. They're willing to pay substantial premiums above the paper price because they've learned the hard lesson. And when you actually need physical silver for production, the COMEX price is increasingly irrelevant. The exchange can print unlimited paper contracts, but they can't print physical ounces. Physics and geology don't care about financial engineering. This brings us back to those 40-50% premiums we discussed earlier, but now you understand why they exist and why they're not going away. When physical dealers charge $100 per ounce while COMEX shows $65, that's not price gouging. That's the market revealing the true cost of actual silver versus paper promises. According to precious metals dealer surveys, these premiums have been widening throughout 2025, not narrowing. The gap between paper and physical is on a temporary disruption. It's becoming the new normal as the paper market loses credibility with anyone who actually needs the metal. We're watching a slow-motion train wreck where everyone can see the collision coming, but the mechanisms to prevent it have been disabled by the very people who were supposed to maintain them. The 5 consecutive years of deficits aren't reversing. The industrial demand isn't slowing down, the mine production isn't increasing, and the institutional short positions aren't being closed. Instead, margin requirements get raised to slow the rally. Mysterious trading halts buy time, and the gap between paper and physical widens to levels that would have been unthinkable just a few years ago. The endgame is approaching, and understanding what happens next might be the most important financial knowledge you can possess as we head deeper into 2026. The divorce is final. Paper silver and physical silver are no longer the same asset, and pretending otherwise could cost you everything you've worked for. Right now, while COMEX officially quotes silver between $65 and $69 per ounce, walk into any physical dealer in America and you'll be paying $90 to $100 for that same ounce. That's not a typo or a temporary disruption. That's the new reality of a market that's split into 2 completely separate universes. One exists on computer screens where contracts can be created with keystrokes. The other exists in the physical world where actual metal must be mined, refined, transported, and delivered. Think about what you're really buying when you purchase a silver futures contract on COMEX. You're buying a promise that at some future date you can either settle in cash or take delivery of physical metal. But here's the question that should keep you awake at night. What happens when everyone holding those promises decides they want the actual metal at the same time? What happens when the vaults are empty and the industrial buyers are demanding delivery or their factories shut down? According to metals, industry sources tracking physical flows, industrial buyers have already figured out the answer to that question, which is why they're abandoning the exchange entirely. Major manufacturers are now signing long-term supply contracts directly with mining companies, cutting out COMEX and the entire paper market infrastructure. They're willing to pay those premium prices, $90, $100, even higher, because the alternative is production halts that cost them millions of dollars per day. When you're a solar panel manufacturer and your assembly line stops because you can't get silver paste, you're not worried about saving $20 per ounce on your metal costs. You're worried about staying in business. This shift has profound implications for everyone who thinks they own silver through paper contracts or exchange-traded funds. The liquidity is draining from the paper market as the real users of silver exit stage left. What's left behind? Increasingly, it's just phantom paper gamblers trading contracts back and forth, while the actual metal moves through entirely different channels at entirely different prices. You're watching the paper market become irrelevant in real time, and most investors haven't even noticed it's happening. Now, let's talk about the mathematical inevitability that's been building for 45 years. Technical analysts have been tracking what they call a cup and handle pattern in silver's long-term price chart, a formation that took nearly half a century to develop. According to technical analysis, principles documented by the CMT Association, when a pattern of this magnitude and duration finally completes, the price targets are proportional to the size of the pattern. For silver's 45-year cup and handle, that mathematics points to prices between $90 and $140 per ounce by mid-2026. But it's not just the charts telling this story. JP Morgan's own analysts, yes, the same JP Morgan that is catastrophically short silver, have projected gold prices reaching $5,500 per ounce in the coming year, according to their commodity research reports. Here's why that matters for silver. Historically, the gold to silver ratio tends to revert to certain levels during bull markets. If gold reaches $5,055 and silver maintains even a conservative 60-to-1 ratio, you're looking at silver above $84. But during peak demand periods, that ratio is compressed as low as 30-to-1 or even 15-to-1. Do the math on those scenarios, and you're staring at triple-digit silver prices. Have you considered what happens when the first major factory halts production due to silver shortages? Not a temporary delay or a minor disruption, but a complete shutdown because the metal simply isn't available at any price. According to supply chain analysts, we're closer to that scenario than most people realize. When one factory shuts down, the panic buying from other manufacturers who want to avoid the same fate will send physical prices vertical, regardless of what the paper market shows. The COMEX spot price could still say $70 while actual ounces trade for $150 or $200, if you can find them at all. This is where the really dark part of our story emerges, and you need to understand this before it's too late. Buried deep in the contract specifications and exchange rules are clauses called force majeure, legal language that allows the exchange to void its obligations under extraordinary circumstances. When the COMEX vaults run dry and they can't deliver the metal that contract holders are demanding, they have the legal right to simply declare force majeure and settle all contracts in cash at whatever price they determine is fair. Let me paint that scenario clearly for you. You've watched silver rally to $80, $90, maybe even $100 per ounce. Your paper contracts show massive profits on screen. You're planning to take delivery of physical metal, or at least sell at these elevated prices. Then one morning you wake up to an announcement. COMEX is invoking force majeure due to delivery failures. All contracts will be cash settled at a price determined by the exchange. Let's say they pick $50 per ounce, roughly where silver was trading before the crisis became undeniable. Your $100 paper silver is now worth $50 in forced cash settlement, while anyone holding physical metal is selling it for $120 to desperate industrial buyers. According to exchange rule documents available on CME Group's website, these force majeure provisions are explicitly written into the contract specifications. They're not conspiracy theories or worst-case paranoia. They're actual legal mechanisms that can be triggered when the system fails. And make no mistake, the system is failing right now. Those 40-50% premiums, those mysterious trading halts, those margin requirement increases, they're all symptoms of a market structure that's reached its breaking point. Think about your own portfolio for a moment. If you own silver through an ETF, do you actually own metal, or do you own shares in a fund that owns contracts that promise metal? If you own futures contracts, what happens when delivery day comes and the vault is empty? If you own mining stocks, you have exposure to silver prices, but you don't have the metal itself. The only true protection in a force majeure scenario is physical possession, actual ounces of silver in your possession, outside the banking system, beyond the reach of exchange rule changes and contract settlement modifications. The international buyers have already figured this out. According to import data from multiple countries, central banks and sovereign wealth funds have been accumulating physical gold and silver at record rates throughout 2025. China, Russia, India, nations that understand the difference between paper promises and tangible assets, are stockpiling metal while Western investors chase paper returns. They're not doing this because they're smarter than us. They're doing it because they've read the same contract clauses, seen the same supply deficits, and calculated the same endgame scenarios that we're discussing right now. Here's the empowering part that you need to understand. Knowledge is power, but only if you act on it before everyone else figures it out. Right now, you can still buy physical silver even if you have to pay those premium prices. Yes, it's frustrating to pay $90 or $100 when the paper market shows $65. But what's more frustrating, paying a 40% premium today or watching your paper contracts get force settled at rigged prices while physical metal trades at $150 and you can't access it? We're Americans, and we've been taught to trust our financial system, to believe that markets are fair and contracts are honored. But the November shutdown and the December breakout revealed something that changes that calculus entirely. When the system is threatened, the rules change to protect the system, not to protect you. The 1980 Hunt Brothers playbook proved they'll change the rules mid-game. The 2025 margin increases, and trading halts proved they're willing to do it again. And the force majeure clauses prove they have a nuclear option ready when nothing else works. The mathematical reality is undeniable. 5 years of deficits totaling hundreds of millions of ounces. Industrial demand at 120% of mine production. JP Morgan's catastrophic short position threatening their Tier 1 capital. The 45-year cup and handle pattern pointing to 90 or $140 targets. Gold projections pulling silver toward triple digits. It all points to the same conclusion. The paper market is going to fail. And when it does, the only thing that will matter is whether you hold actual metal or paper promises. This isn't about fear or panic. This is about understanding the game that's being played and making informed decisions about your financial future. The institutions that manipulated silver prices for decades are now trapped by their own manipulation. They can't close their short positions without triggering the very price explosion they're trying to prevent. They can't admit the paper market has failed without causing a panic. So they'll keep changing the rules, keep raising margins, keep implementing mysterious trading halts, right up until the moment they invoke force majeure and settle in cash at rigged prices. You've seen the evidence, you understand the pattern, you know what's coming. The only question left is what you're going to do about it before the window closes and physical silver becomes unavailable at any price. Because when that factory shuts down, when that force majeure gets triggered, when the paper-physical divorce becomes obvious to everyone instead of just the informed few, by then, it'll be too late to act. The choice is yours, but the clock is ticking and the endgame is already in motion.